Okay, let's continue talking about profitability. And by the way, as you look down through the Moodle site, you'll see that there are several videos, one for each type of ratio category. When it comes to the market ratios, I've actually provided some individual explanations on those videos. So I think you have more than enough resources to truly understand what the ratio analysis is all about. So let's go on here with profitability. We can look at profitability just by looking at the income statement, or looking at from an income statement point of view. And there are really three numbers that are important. The most important number, or at least the number that you hear the most about, is something called the profit margin. It's referred to as the bottom line. In the end, it is net income divided by sales. So in this case, 15.7 cents out of every dollar of sales ends up at the bottom line. And of course, we would like to find ways to increase that if at all possible. But there are two other ratios that I think are just as important, if maybe not even more important, certainly from an internal performance perspective. The gross profit margin is gross profit, which is sales minus cost of goods sold, divided by sales. So we end up with 41.84%. Gross profit margin illustrates how well management is controlling the expenses and the costs of production. So in this case, 41.84 cents of every dollar ultimately is accumulated, right, in the form of profit. So it shows how well they control things. Now, it would be much nicer if we could show historically, compared to last year, compared to the industry. But again, in this case, at least we show what? That 41 cents of every dollar is what's left over after we've paid for production costs. The next line item then is the operating profit margin. And this goes down one profit number further, EBIT, operating profit, divided by sales. Now this includes all the expenses of running the company. So it includes all the operating expenses. It includes depreciation, the salaries of management, research and development. All of those expenses associated with operating the company are included in this number. So after all the expenses of operations are incorporated, the company still has 29.9 cents of every dollar left over to pay for other things. Well, what else is left to pay for? Well, if you look at the line items, right, we only have interest and we only have taxes. So the operating profit margin number gives us a picture, if you will, of how well the company overall is managing the expenses of running the company. The next set of ratios then that we want to talk about are more balance sheet oriented ratios. And really we have three that we want to discuss. The first one you may hear from if you're working. You may hear companies talk about this a lot. They don't usually refer to it as return on assets. They call it return on investment. And we typically use this for projects. What is the return on the investment in the project? So in this case, you see it's 10.12%. So that's the profit that's generated based on the assets that were purchased. Now the challenge with this number is that net income, if you look at the line item up here, includes taxes. So companies that have different financing strategies, we talked about leverage, companies with different leverage will have numbers that are different, not because management is different, but because the way they've chosen to buy their assets is different. So making comparisons to other companies or to an industry with return on asset, it has some problems with it. Now, if you're using it internally for your own company and you haven't changed your finance mix, then there's no problem in looking at this and making comparisons historically. Return on equity basically shows the profit left over to pay for or attributed to the investments of the shareholders. So this company provides a 14% return to its shareholders. I think return on equity is fairly easily understood. Basic earning power is a ratio that's not in your text, but I think it's important from the perspective of return on assets. Basic earning power stops before interest, so it's EBIT, operating profit, divided by total assets. So this tells me about the profits generated from operations based on the assets we've purchased. And again, this number is a powerful number to look at performance and to give some guidance on how well management is using the assets that it has to help generate some profits. The market value ratios are fairly complicated. There's a couple of videos that you might want to watch that will help you understand these a little bit better. But for this company, we have $88 is the share price. Outstanding shares 33 million. So again, we can look at these calculations. Earnings per share is net income divided by the number of shares. So the earnings per share for the year is $11. The PE ratio measures how optimistic investors are about the company. So in this case, the PE ratio is the market price divided by earnings per share. $88 divided by the earnings per share of 11 means that the PE ratio is 8. So what I will tell you is that historically the S&P 500 is between 12 and 20. So just from that piece of information, we might be able to surmise that maybe this company, as shareholders don't view this company as being a very good investment. It seems to be undervalued, or at least it has a lower price. Now that could be an indication that we need to buy because the price is too low. But it could be an indication that the company is not being run very well and investors don't see it as a good opportunity. Price to sales ratio, likewise, is a number that gives us a picture of how well investors view the sales potential of the company. In this case, it's 1.26 times. Again, we need something to compare that to the industry or history. But again, it's a number that tells me how investors feel about the sales provided by the company. The market to book ratio is important to understand from the perspective of mergers and takeover kinds of activity. The market price represents the price to buy the entire company. The book value per share represents the price. It's the accounting value, but it represents the price to build the company that looks exactly like this one. So which would you rather have? Which would you rather do? Would you rather buy the company's stock for $88 or build the company for $78.52? Well, the number 1.12, it's greater than 1, so what it tells you is that the market price is greater than the accounting value, which means investors managers are doing some good things. They're increasing the value of the company. They're trying to maximize the share price for investors. Now, the bigger this number gets, the better the company is performing. But if it gets too large, we may say that maybe we're in a position where the stock is overpriced. Again, without looking at history, the industry, etc., it's very difficult to make ventures as to exactly whether this number is good or bad. Bigger numbers are much better than lower numbers, but I'm not sure exactly where we would go with respect to this particular ratio and its analysis. The enterprise value, or essentially we're going to talk about something called EBITDA ratio. The enterprise value basically asks this question: how much would it cost to buy all the stock, pay off all the debt, and then what would be left over? So in this case, it's the cash purchase to buy all the stock and pay off all the debt. This essentially turns the company into an unlevered company, a company with zero debt. Now it only has equity. So your textbook uses total liabilities. It uses all of debt. Some books may only use long-term liabilities. But in general, we see here that the enterprise value is $38.03. That's what it would cost to buy the entire company and convert it into a non-leveraged debt company. The EBITDA value basically takes that enterprise value and divides it by EBITDA. EBITDA is earnings before interest and taxes plus the non-cash expenses. So in this case, this cash flow number is 967. So the EBITDA ratio is 3.93. Sometimes this is called the enterprise value multiplier. In this case, the bigger the number, the greater the growth opportunities of the company. So if you think your company is a growth company, you would expect this number to be bigger rather than lower. Again, we may want to investigate how we've been acting over the future. What is the strategy of the company? Are we a growth company, or are we more of a stable defensive kind of a company? Again, not knowing history and being able to make comparisons backward makes some further analysis a little bit difficult. So here's the recap of the ratios that we calculated. Again, you can go through, make sure you can calculate all those ratios. You will find all of those ratios. There may be some exceptions of things might be a little bit differently because of the formulas on the spreadsheet, but all of those ratios are available on that spreadsheet, right? They're all right here. All these variables and more are available on this spreadsheet. So it's a very comprehensive calculation of value, etc., for this company. The book doesn't get into this in any real great detail, but we could make comparisons to other companies, and this would allow us to make some comparative analysis. We could also then go out, apparently this is a construction kind of a company, we could then also go out to find industry ratios and make industry comparisons. So again, that's just another step, another depth to go in the financial ratio analysis question. The next thing we want to talk about as we start to conclude this chapter is to talk about something called the DuPont Identity. And if you think about the return on equity formula, the return on shareholder investment, it's very simple. Net income divided by total equity. The challenge with it is, how do you fix this number? If it's too low, how do I fix that? Well, the DuPont Identity expands this number. We take the profit margin, which is net income divided by sales, and we multiply it by the activity ratio, the total asset turnover ratio. And you can see what these things would do is sales would divide out, and of course then we're left with net income divided by total assets, which is the return on asset ratio. We then multiply that by what's referred to as the equity multiplier or the financial leverage multiplier. Now total assets divides out, and we're now left with net income. So how can we use this number? If you want to increase return on equity, you need to increase profit margin. This measures the company's operating efficiency. How does it control its costs? Total asset turnover ratio. We need to measure asset usage efficiency. How much assets do we have? Are we managing them well? And finally, the last question is about debt. we need to understand how much debt the company has. If you want to increase returns to investors, to creditors, to shareholders, that is, you need to increase the equity multiplier. That means you have to increase the debt of the company. So for Prufrock's DuPont Identity, we can do this calculation. We can find out that profit margin is 15.7, total asset turnover is 0.64, the financial leverage multiplier is 1.39, so we roughly get that return on equity number that's around 14%. So as a manager, we need to figure out, how do we increase profits to the shareholders? We need to focus on those three areas. The next discussion then talks about growth and how we measure the growth opportunities within the company. So let's first talk about dividends. The dividend payout ratio is dividends per share divided by earnings per share. So again, that's just how much money out of the profits has been distributed to shareholders. The retention ratio is the retained earnings, the addition to retained earnings divided by net income, or it's 1 minus the debt payout ratio. So earnings per share belongs to the owners, and some of that money is distributed and some of that money is retained. This is just the relative ratios. That, of course, if you add those together, it adds up to 1. It's 100%. So here's the dividend payout ratio for this company. It's the cash dividends, 121 divided by 363, 33.3% of its profits were paid out as dividends. So that must mean, if we go to the retention ratio, that 66.7% of the money was retained. Again, you don't really need to calculate both of these. Calculate one and then just do 1 minus, and you get the other one. So 2/3 of the profit of this company is reinvested in assets and asset growth, either buying new assets or replacing old assets. So the first growth ratio to talk about is something called internal growth. How much can the firm grow? How much of its assets can grow using retained earnings as the only source of financing? So if we want the company to grow, we got to figure out how to pay for it. Well, how do you pay for it? You either pay for it internally using profits or retained earnings, or you use money in addition to internally, you use money that's external. So the internal growth rate, you take, again, it's the return on assets times the debt ratio or the retention ratio. And again, you divide it by 1 minus that. So in this case, the internal growth rate is 7.23%. How much can the company grow and not need external sources to finance asset growth? The growth rate is 7.23%. So if we were to forecast that the company is going to grow at 6% next year, then we would not need to think about external financing. We would be able to finance that entire growth with profits of the company. The sustainable growth rate then is how much we would be able to grow by using internally generated funds and issuing debt, but not by issuing new common stock. So again, the question just goes one step further. The company wants to grow. We need money to finance it. How much can the assets grow without necessitating the the issuing of common stock for that growth? So the answer to that is 10.29%. So if we predicted that the company was going to grow by 12%, how would we finance that? Part of the financing would come from retained earnings. Part of the financing would come from the debt ratio from financing. But since 12% is more than 10.29%, that would require more money to buy the assets. So we would have to issue common stock. So, what are the determinants of growth? Profit margin, the total asset turnover ratio, the efficiency of the company, optimal debt ratios, and in the end, the dividend policy is going to help us understand how much we can grow. If we want to pay less dividends, that means we'll have more money to invest internally. We won't have to involve external shareholders. So these are the four primary determinants of the growth rates of companies. So, in the end, why would we want to analyze financial statements? We need them both internally and externally. We need to develop some understanding internally of how well we're performing now and where we're going to go in the future. And of course, our creditors, our customers, everybody is interested in our stability. How long are we going to be able to do the things we do in the future? We can benchmark. We want to figure out, what are we going to compare to? Are we going to look to time trends, look at our company historically? Are we going to compare ourselves to peer groups? We can go by the SIC number or the NAICS number, which are industry codes. So you can find industries and you can find the codes for those industries, and you can figure out how your company stacks up with your ratios compared to the industry's ratios. And in the end, the last thing we're talking about, we just have to realize that there are some problems with financial analysis, right? Nothing is ever nice and easy. Most companies have more than one industry involved with them. If you just think about Disney, right? Disney has television. Disney has movies. Disney has food products. Disney has retail, right? Disney is everywhere. Disney has the hotel operation. All of those things are different industries, but they're all included in one set of financial statements. We have to worry about accounting procedures, differences in capital structure, one-time events. What happens if something bad happens? It's only going to happen once, but how do we use that information to analyze where the company is going and make comparisons to the past? So financial ratio analysis is intense. There's a lot of stuff going on. The calculations are easy, but the thought process and the understanding is a little bit tense. That's chapter 3. I'll see you in chapter 4.